Welcome to Nasdaq Trade Talks. I'm Jill Malandrino, global markets reporter at Nasdaq. Joining me is Phil Mackintosh, chief economist at Nasdaq, for an update on the latest COVID-19 news, the U.S. and global economies, and how markets are digesting the progress of our reopening. And Phil, large cap companies, they're expected to see earnings back to record levels in Q4, but other older economy stocks are expected to see a much slower recovery. That certainly seems to be the narrative for this quarter.
Yeah, that's what's being priced in by analysts, and it speaks to a lot of the topics we've been talking about, doesn't it? Where and when you say large cap growth, really you're talking about a lot of the Nasdaq listings, the Amazons that are well positioned for online retail, the Netflix, which a lot of people are probably watching to keep themselves busy, Nvidia because everybody's playing their video games, I guess. Lots of those types of companies are the large cap growth companies, and their earnings haven't been hurt nearly as much as other companies, industrials, materials, energy spaces. So we're seeing the outperformance already because people kind of know this. It's expected. It's one of the reasons why the Qs has outperformed a lot of the other large cap indexes. But I think the real point is the V-shaped recovery that it looks like China has seen is probably not going to happen to US corporates, at least not based on the current expectations. We're seeing some good rebounds from the Q1 sort of March, April, in terms of short-term sell-off. We've got a lot of good data coming out right now that people are definitely getting back to work, but the longer-term forecast shows that slowing down and taking a lot longer than we had initially hoped to get back to what you would call normal levels.
So let's take a look at what happened with China on the overnight. It seems as if they had some pretty good data in terms of GDP, but the market didn't exactly respond to it well.
Yeah, I mean, there's a lot of things going on in China. It's had a pretty good rally the last week or so. A couple weekends ago, there was a government newspaper that posted a story saying that people would be well positioned to be in the market, and the market had a really strong rally. So it potentially got a little bit overheated anyway. But yeah, overnight, the market was down about 5%. And that's on the back of the fact that China has actually seen a V-shaped recovery. Its GDP rolling year is actually back to positive after that dip that it saw in Q1. And remember, China was seeing coronavirus in January, February, so Q1 saw almost all of its shutdown. You can see it's pretty much back to work. We've been showing some of the data, and the GDP for Q2 pretty much proves that it has managed to engineer a V-shaped recovery by having super strict lockdowns. But inside some of that data was a little bit of weakness in retail. We know there's a little bit of weakness in air and rail travel. It's not as back to normal as people think. And that plus the fact that it was probably a little bit overheated seemed to have hurt it overnight.
Yeah, and so I want to take a look at what we're looking at, for the third quarter of 2020. You have a couple of data points here. We're talking about hospitals. We're talking about airlines furloughing multiple thousands of people. Eviction, is around the corner. There's still a lot of variables that we need to grapple with.
Yeah, and this week we've been talking so much about vaccines and all the success that we're having with vaccines, and how if a vaccine is successful, then maybe 2021 is going to be a pretty normal year. But in between now and then is 6 months of reality. And so some of the data that's out today with American Airlines potentially furloughing workers, there's companies out there that are going to run out of assistance and run out of stimulus, or just realize that this recovery is going to take longer for their industry, and they will restructure and they'll have to save costs. And that turns this into a little bit more of a classic recession. And that makes it a little bit harder to get out of too, because then you've got people that are longer term unemployed, less confident about the economy, not spending as much, and you get that slightly vicious cycle of less spending creates less revenues, which creates more redundancies. So that's something the government's been conscious of with all the stimulus that it's pumped into the system, but it can't go on forever just because we can't all afford it. And so there's going to be some industries that do start to have a reality check, and evictions are another thing where real estate owners are potentially going to be having losses now, and then eventually there'll be credit exposures to banks. And we saw a lot of extra provisioning by banks earlier this week, about $30 billion, to account for some of that as well. So that, combined with the fact that there's a bunch of new cases still coming through in the southwestern US states, means we're probably going to see a slowdown in coronavirus in the medium term as well. All headwinds that we need to keep in mind, even though the vaccine news this week's been really good.
Let's take a look at yield and revenue. It seems to be that everyone's looking for income in such a low rate environment.
Yeah, I mean, these are interesting charts that I saw today. And the one chart looking back into the sort of 1800s just shows that the equity market used to provide about a 4 to 5% yield in dividends. And that's declined pretty significantly between sort of 1980 and 2000. And it's now below 2%. So for anyone looking for yield, stocks aren't as good a yield play as they were before. But what's I think important is at the same time, we've seen interest rates come down significantly. So actually, in recent times, the yield, that lower yield on stocks, is still quite a lot better than some of the yields you're getting on, say, 10-year bonds. So it's becoming harder and harder to build an income portfolio. And it looks like we're with coronavirus and with what we're talking about, potentially slower economic growth for longer, interest rates will be pretty low. And that's one of the things, the search for yield and the fact that the dividend rates are better than the bond coupons right now is just one of the things that's helping support the market and keep the market up too.
All right, Phil, I want to wrap up with something interesting that you point out in regards to how we hear the government protected revenues are too high and what that means for the exchanges. But what about the stimulus that the banks got from the Fed in just one quarter?
Yeah, that's true. There's a couple of stories going around about the banks making a bunch of money on bond trading this past quarter. Obviously, the fact that the Fed sort of stood in the market when things were turning south and provided a lot of liquidity created a little bit of a safety blanket for them. This is one of those economic realities that the frictions in the bond market add up to quite a lot more money than the frictions in the equity market. Really, when you add up all of the equity market frictions, they're immaterial compared to some of the profits that come off trading desks and fixed income.
All right, Phil, great to have you with us as always. Thanks for joining me on Trade Talks.
Thanks, Jill.
All right, and thanks for joining me. I'm Jill Malandrino, Global Markets Reporter at Nasdaq.